Stocks will crash and the economy will suffer.
Here's the real question. If things are bad as crazy.
We are living in the riskiest market since 1929, and the U.S. is on the verge of falling apart.
The stock market is crazy. Between headlines, market crashes, and scandals, it's enough to make you just want to keep your cash under the mattress. But are stocks really that risky, or is it just what you're made to believe? In this video, I'll show you why stocks are not nearly as risky as you might think, how investing has become an entertainment industry to distort your view of risk, and how to find the right stocks to buy for low risk and high return. We're talking stock market risk today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and you know I gotta send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, I know the stock market can be intimidating. Putting your hard-earned money on the faith that some faceless corporate managers are going to use those assets to create a return, and then watching the news or investment analysis only makes it worse. Happy investors do not make for good front-page headlines. Instead, you see news of scandals, impending crashes, and even the not-so-occasional sensational tweet. And the tragedy here is that this invented chaos causes investors to stay out of stocks and miss the best opportunity that you have to make your money work for you, creating that financial future you deserve. Because the truth is, stocks are not a fraction as risky as you might think. The problem is where you get your stock information. You see, the media, websites, even right here on YouTube, it's all built on an advertising model. The more dramatic, the more chaotic they can make investing seem, the more you're going to come back for more, and the more advertising dollars they can sell. Investing has become an entertainment industry. The truth is, as the first American to win the Nobel in economics put it, real investing is like watching paint dry, except more boring, like watching paint dry in slow motion. In this video, I'll first show you 2 reasons why stocks are not as risky as you think. Then we'll look at how to find stocks that will produce a great return on the lowest of risk. Stick around though, because as a bonus towards the end of the video, I'll reveal how to make even the riskiest stocks a stress-free investment so you can sleep at night while your money grows. And the first reason here stocks aren't as risky as you might think is because while the news might focus every day on those most sensational stories, the riskiest stocks, there are thousands of stocks that are a fraction of that risk. In fact, there are whole groups of stocks that are less risky than others. There are 11 sectors of the economy, broad groups of companies that provide a common service or product. And while some of these, like technology and communication services, are home to some of those high-risk, disruptive stocks, some of these sectors have the kind of stable cash flows that all but guarantees a smooth return over time. So here I've listed the ticker symbol for funds that hold stocks in each sector, along with the standard deviation for each group. Now, without getting all math nerd on you, standard deviation is just a measure of volatility or of risk. It shows how much that investment tends to rise or fall on any given year. And you can see that some of these stock sectors do tend to rise and fall quite a bit. The XLF, the fund that holds stocks of financial companies in the S&P 500, has a standard deviation of almost 25%, a quarter of its value. Industrials, materials, energy, all stocks in those sectors with the potential to fall more than 20% on a bad year. But some of these other sectors, the safety sectors like utilities, real estate, and healthcare, the companies in these sectors have stable cash flows even in a recession, and the stocks are much less volatile. Now I know you're still saying, but I saw shares of Tesla plunge 10% the other day. How can you say stocks are not risky? But now nobody holds just one stock, or I hope you're not holding one stock. Holding more than one stock, holding a group of stocks like in the bonus strategy I'll show you later, that's going to significantly lower the risk in your money, but still help you make those higher returns. Next, I'm going to show you a quick way to find stocks with low risk and high returns. But first, I want to get your opinion on this to see where the community is at on that risk. Would you rather have a 10% chance of making $1,000 on an investment or an 80% chance of making $125 on a different investment? And in both cases here, it's all or nothing. It's that 10% chance of 1,000 or 90% chance of nothing. So scroll down and let me know in the comments below the small chance of a big return or the almost definite smaller return. And here, before I reveal that bonus investing strategy, I want to show you a simple way to find stocks with lower risk but still higher returns. We'll be using Yahoo Finance here because it's free, but you can find this on any investing app. First, you're going to look for what's called the beta, shown here on the stock's profile page. Now, beta is just another measure of the stock's volatility. It shows how much the stock tends to rise or fall relative to the rest of the market. For example, here we see that shares of General Electric have a beta of 1.07, which means that they're only a little bit more risky than the general market. Now, this doesn't happen every day, but this says that GE tends to rise or fall by 1.07 times what the market does. So if the market falls by 0.54%, as it did this day, we would expect GE to fall by a little bit more, by about 1.07 times that, or by about 0.58%, which it did a little bit more than that today. So now looking for this beta number, you can look through a few different stocks to see which is lower risk. Here you see Tesla is about twice as volatile as the market, with a beta of 2.0. Here we see that AT&T has a beta of just 0.74, which means it's less risky than the market. This means we would expect shares of AT&T to rise or fall 0.74 times what the market does. So for example, if the market falls by 1%, we would expect AT&T to only fall by about 0.74% on the day. And last here, we see Coca-Cola with a beta of just 0.61, the least risky of all. Of course, it's proving me a fool today because it fell more than the market, but this beta is calculated on a 5 years of data. So again, remember, this idea of risk is going to be on that average over months or years, not necessarily just one day to the next. Then for an idea of the potential return on these, you can look at this average analyst price target on the stocks. Taking that number divided by the current price gives you a forecast for return over the next year. So for example, the average target of $59.62 per share for Coca-Cola gives us an expected return of 9% from the current price. Here we can go back to GE and see the average target of $14.97 a share gives us an expected return of 11%. Now these analyst price targets aren't gospel. I know some analysts that would have a hard time finding their ass even if it had a neon sign on it, let alone forecasting stock prices. But using the average here can give you a rough idea of that return expected on a stock. Now using that along with the stocks with low beta is a quick way to find those low risk, high return investments. So you see, you can find stocks that produce a solid return on lower risk, but the fact is there is a very clear relationship between risk and return. Those stocks with the most risk of falling 10 or 20% are also the ones that can make you 30 or 40% of your money. So now I want to reveal an investing strategy to get the best of both worlds, a strategy to invest in the most volatile stocks, but without all the risk. The strategy is going to focus on 2 ways to invest in those high-risk stocks that is going to reduce the overall risk to your money. And the first is to invest in exchange-traded funds, ETFs that hold risky stocks. ETFs are groups of stocks held in a fund, and then you buy shares of that group, just like you'd buy shares in any individual stock. And here you can find ETFs that invest in themes like tech stocks, high growth companies, stocks that individually would be considered very risky. But by investing in this group of stocks, you get an investment that is much less risky than those individual companies. As an example, let's compare shares of the ARK Innovation Fund, ticker ARKK, a fund of 51 companies in disruptive technologies. Now, individually, these are some of the riskiest stocks in the market, but also some of the best returns you can find. If we go back to that idea of beta and look at some of these stocks in the fund, here we see Ceres Therapeutics, ticker MCRB, a stock I recommended back in December 2019 at $3.45 a share, but you can see how volatile it's been over the last year, and that beta is nearly 4 times the market. Here, CRISPR Therapeutics, ticker CRSP, another stock I like, but with a beta of 2.25. And remember, that means it's more than twice as risky as the market on that measure. Even shares of Tesla, which are in this fund, have a beta of 2 times the market. But then holding them all together in a fund, the overall volatility in that group is a fraction of that. The beta on the fund itself is just 1.5 times, still riskier than the market, but much less so than the individual stocks within it. Now this way, investing in these funds, you still get those higher returns, but with lower risk. Some other examples of these high return types of funds are the ARK Next Generation Internet ETF, ticker ARKW, producing a 616% return over the last year. The Amplify Online Retail Fund, ticker IBUY, with its 416% return. And the Invesco Solar ETF, ticker TAN, with a 324% return over 5 years. Now, another way to invest in these riskier stocks, still benefit from those higher returns, but without the risk, is by holding those other funds and the stocks from different sectors. Now, this is a core concept of investing called diversification, a way of spreading your money across different types of investments and lowering your risk. Having more investments from different sectors means some are going to rise while others fall, smoothing out the overall risk in your money. Again, here we see the riskiness or the volatility in a few individual stocks. Tesla is twice as risky as the market. Ceres Therapeutics 4 times as risky on that beta measure. Even a fund here, the Amplify Online Retail, is more than 1.5 times riskier than the overall market. But look at what happens to the overall risk if we add some ETFs or just a few other stocks. The overall portfolio with a beta of just 1.12 is only a little more risky than the overall market. You still get all the upside on these stocks, but lower your risk. Click on the video to the right for the 8 questions you need to answer before you start investing. 8 steps to get started making your money work for you. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.